Hi everyone, I'm Astrid Daniela Galvez. As a fellow business owner, I'm passionate about helping other small businesses succeed. I've partnered with QuickBooks to help demystify accounting because I'm pretty sure that's not why you started your business. I have just the thing to make your life a lot easier. Accounting equations that every small business should know to check the financial health. If you want to read more about it, check out the article linked in the description below. But before we get down to the bottom line, be sure to give this video a thumbs up and subscribe to the QuickBooks channel so that you don't miss out on videos like this one. If you're a business owner, it's essential to have your finger on the pulse. As a business owner, there are 8 simple accounting formulas that you need in order to understand the health and viability of your enterprise. Even if you have someone else handling your accounting, having a good grasp of these 8 accounting equations will better equip you to manage your business. Let's start with the accounting equation. Simply, it's the value of all the assets of your business, including property, equipment, inventory, and cash, minus all liabilities, such as bank loans, lease payments, and or outstanding debts. The difference is the business owner's equity, or how much they own in the business. Next, we need to look at your net income. It's the total profits after deducting all of your business expenses. If you subtract the cost of making a sale from the sales revenue, then you get net income. If this value is positive, then your business is profitable. But if the value is negative, then you're losing money. When you're making something, it's good to know how much product you have to produce to cover the cost of making that product. That's called the break-even point. We start with the fixed cost, such as rent, insurance, and payroll. Divide that by the sales price of the product you're selling minus the cost of producing that single item. The answer is the amount of product you have to sell in order to cover the cost before making a profit. We have a much simpler accounting formula next. Cash ratio. Divide the cash or liquid assets your company has at its disposal by the current liabilities. The higher the number, the healthier your business. Are you still with me? Good. We're almost done with all these accounting formulas and equations. Next up is an excellent metric for businesses, the net profit margin. To calculate net profit margin, divide that net income that we worked at earlier by the total sales generated. And again, the higher that net profit margin, the better shape your business is in. If you need additional capital to run your business, particularly in the early years, lenders like to look at the debt to equity ratio, which is measured by dividing the liabilities by the equity the owners have in the business. Keeping it low will make your business more attractive to banks and investors. The cost of goods sold is a good indicator of how the production costs stack up against the revenue you earn from selling that product. Subtract the total cost of sales from the cost of making the product. To learn more about the cost of goods sold, visit the link here. The last accounting equation is retained earnings, or the money that is kept within the business during an accounting period. With a new business, it's the net income minus any cash dividends to the owners. Those retained earnings are the starting point for the next accounting period, and so on. So it's a figure that accrues over time. I hope this has given you an insight into a few of the most important accounting equations to help you run your business successfully. Keeping track of these important numbers is simple with QuickBooks Online. A QuickBooks Live expert can help you understand your financial performance so you can make better business decisions. If you found this video helpful, go ahead and hit that like button. We have many more videos like this one, so subscribe to the QuickBooks channel. See you on the next one.